So, hello everyone. Hope all of you are doing fine and hope you are enjoying our Debt Care Fund Day series because we are, enjoying making this series and sharing it with you. So, in the last couple of episodes of this series, we have discussed on the various types of debt mutual fund schemes. And I think so one of the biggest problems that comes with investors is when you have too many choices, you don't know how to make the right choice for you. So today's session is all about how do you select a suitable debt mutual fund scheme. As I mentioned, there are large number of categories and large number of funds you can choose from. Hence, which is the most ideal or most appropriate for an investor is a very tough decision. And that's why we will try and decode how to choose debt mutual fund schemes. Now, when it comes to investing, there are two main things that investors need to match to get a good investment experience. One is their risk appetite, and second is their investment time frame or the tenure. These are two very critical elements that investors need to consider while making the investment decision. Investors also need to consider their financial goals, which they like to make and achieve while doing the investments. We believe that investors should ideally have each investments linked to a goal. And when you start linking your investments with a goal, that's the time you transition yourself from becoming a return chaser to a goal seeker. And that helps you also make your investments with the right time frame. Now, point that we mentioned that two important factors, let's decode those factors. Now, first comes to the risk factor, and risk is a very important element here. So, in risk, essentially, there are two types of risk when it comes to investing in debt. One is the interest rate risk, and the interest rate risk is dependent on the way the interest rates move in the economy. That is something an investor doesn't have, control on. What he can control on is how he can make the investment based on a certain time frame. Now we've seen time and again, and the very essence of investing is if you want to generate higher returns, you have to have higher risk or take higher risk. There is a famous saying that there is no free lunch, and that's how investing is all also about. That when you want to generate higher returns, you will definitely have to increase your risk to make sure your returns match your expectations. Now, the question that will come to your mind is why should I take risk or how can I reduce my risk? So, I think so the best way to reduce risk is by increasing your time horizon. So when you choose any investment which has a higher risk and you increase your time horizon to a longer time frame, your investment experience also improves. Now let's come to the second risk of investing, which is credit risk. And now credit risk is basically also involved with investing in certain instruments where you will need to take higher risk. Now, we have seen in the last few years a lot of credit incidents and accidents happening in the debt markets. And that's where investors need to really look at the credit risk and the credit ratings of the portfolio. Because any instrument which is lower on credit rating will definitely give higher returns. But investors need to consider the fact that the risk also goes up significantly for such investments. And they should do this investment only when they have comfort that they are okay with that quantum of risk. We at Team Mirai have, continuously advocated to our investors and partners that interest rate risk is temporary because, the economy, once it revives, or growth revives, or inflation momentum changes, you will see that interest rates, say the 10-year GSEC, may move from 8% to 6%. And even if it goes back to 8%, over long periods it will come back. So interest rate risk can be mitigated, but investing in the wrong credit or a wrong financial instrument can have a permanent dent in your portfolio returns. And hence, investors need to be mindful of the credit ratings. Now, what investors need to do is that they should map their investment tenure with their risk. Debt mutual funds have various categories, which starts with investment as low as 1 day, and you can even invest in 30-year government securities. So from 1 day to 30-year GSEC, there are various types of debt instruments. Investors need to match their investment tenure with the risk that they are willing to take, and that both will help them make the right investment options. Now, we've discussed many things today, but the question that will always come to the mind is, how does this impact me? Or can you give me some practical ways of choosing debt funds? So we want to highlight a couple of case studies here to emphasize how few variables can be considered by investors, and those variables can help them choose which investment option suits them the best. So let me start with case study one. This is of an individual named Amit. Amit is a 40-year-old man. He is happily married and has a 16-year-old kid. And he is trying to make investments with the goal of children's education or the kids' education. And the tenure that he is looking to invest is 3 years. So one important variable is goal. So his goal is child's education. And what is the tenure he is ready to invest, which is 3 years. From a behavior and a risk appetite perspective, Amit is an investor with a moderate risk profile, and his return expectations are muted or are moderate. He doesn't want to make very aggressive returns while he makes the investment. Now, considering all these factors, what products can he look to invest in? Considering that his tenure is 3 years, his returns expectations are moderate, and his return risk appetite is also moderate. You will see categories like short-term funds, corporate bond funds, or banking and PSU debt funds as suitable products that Amit can look at. Now, in this example, what I want to highlight is we have considered a very simple example. There may be a lot of technical aspects involved, and that's why investors need to speak to their financial advisors and take decisions based on the discussions they have with their financial advisors with respect to their goals, their risk appetite, and how they should approach investing. Just extending this discussion to one more example, we are taking example of Sushma. And Sushma is a 25-year-old self-employed single woman. And because she is carrying out her own business, her goals are she has business liquidity requirements. So when she has money which comes into her business, she is ready to park that money for 1 day or 1 week, which means for very short periods of time. Now, because she wants to invest for short periods of time and the needs the money for a business perspective, her behavior is low risk and higher liquidity requirements. Now, if you see this kind of an individual with a risk profile, investment time horizon, the ideal product that may suit Sushma will be an overnight fund. Again, we would here taken a very simple example, and I'm sure the financial advisor can help the investor make the right choice. So in today's session, what we've tried to do is show in practical aspects how factors like goals, investment tenures, risk appetite make an impact on how investors should choose the right fund for them. And that's where they need to take help of financial advisors to make them help taking the decision making process simpler. And friends, please don't forget to subscribe to our YouTube channel for many such interesting videos. So happy investing to everyone and hope this session has helped you to make the choices of selecting debt mutual funds simple, and we will be happy to hear your views. Thank you everyone.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.